Hi, my name is Cooper Alford, and this is my Session 7 video for my Registered Investment Advisor Asset Allocator system. For our client, given a moderate risk with 40% US stocks, 20% international stocks, 30% bonds, and 10% REI real estate investment trust, very small portfolio, I decided to create a system to accurately calculate his portfolio and asset allocations and any sort of rebalancing needs that he might need for a quarterly update uh, check. We have our basic imports we've all seen: Numpy, Pandas, MATLAB, Seaborn, Deity, datetime and warnings, Plotly for graphs, sets up our basic functions. We have 8 different modules: data, risk, portfolio management, Black Litterman, and Monte Carlo, which each were given a separate module to showcase their concepts that we've learned in this session. Validations, module 6. Then we have um, our rebalancing if needed, and module 8, which is our actual output. So let's get into our basic module 1. First off is our data configuration. We have our 4 different asset classes: US stocks, international stocks, bonds, and real estate investment trust. Gives our basic metrics: our target weight, which was given to us, 40% obviously for US stocks; our min and max, which gives us our rebalance threshold of 5% in each direction, which is basically the max amount of drift that we can take for a certain amount of asset class before we want to rebalance. So let's say if uh, US stocks had a lot of excess return and ended up just taking up more money of our portfolio, ended up being a higher weight. If that exceeded 5%, we would need to rebalance. We would check that every quarter, and then we would give it a rebalance by selling them a certain amount of those UX stocks and buying something that we're more deficient in to average out and keep things nice and stable in our portfolio. And then our basic expected return and volatility for all 4 asset classes. We're given our quarter 1 performance data. Our correlation matrix, a perfect one between an asset class and itself. Obviously, bonds are the only thing that's really negatively correlated, as it has such a low volatility and follows a different market from the two different stocks. And the real estate investment trust, which relatively in this big asset class with so many different things, has a similar correlation, at least compared to bonds, to the 2 different stock markets. Then our basic risk management parameters, our portfolio volatility, minimum Sharpe ratio, max single asset weight of 50%. And we want to rebalance every quarter. And then our client constraints, so they have tax considerations, so we need to check out that. I have a decision tree to set up to decide if we need to check out our tax considerations. They have 5% liquidity needs. They need to spend things 5% of whatever they have in their portfolio annually just to cover different expenses they have. And our time horizon, we're going to say 20 years, assuming they're like in their 30s, they have 20 years to retire or whatnot. They don't need to distribute any other wealth. So we have our initial configuration. Going to module 2 is our risk management framework. Sets up a lot of our basic metrics for our portfolio optimization. It gives our expected returns and volatility. It's very basic. Our portfolio expected returns given from our weights and the problem for each asset class added up together for our full portfolio. And then also our correlation matrix, like saying bonds being very negatively correlated, it's going to give us a lot lower volatility, which is good for this portfolio, and that's why you want that diversification there. Our risk-adjusted metrics from our excess return and Sharpe ratio, and our downside risk metrics. We'll get into a value at risk of 95%, but that's basically the 95% chance that you're not going to lose a certain given amount, which will be given to us from the problem. So we'll go over that later, and our expected shortfall, which is what we're expected to lose. Returns all those, goes into our tracking errors and whatnot. Make sure everything works correctly, and it gives our risk limits. Make sure that everything's within a reasonable limit. Concentration, Sharpe ratio, and volatility, and then we move back on to module 3, so our actual portfolio optimization. We have 2 different portfolio optimizations in this: our mean variance and our target risk. There's also could have been Black Litterman just on its own portfolio because of its basis on market data and the market equilibrium, but decided to give that its own module. So here we have a portfolio optimizer. It gets our strategic allocation based on our given weights, and after quarter 1, it'll use our given data to estimate after that going forward. Gives our quarter 1 return, our new value, and then calculates our new weights based on that, based on how much return was changed over quarter 1 or going forward and whatnot. And if it's within our rebalancing standards, then our mean variance optimization, calculating the best portfolio along our efficient frontier, who gives the average volatility. So it's just a risk aversion of 2 with a moderate investor, gives our negative maximum, minimizes negative utility, so it's our max like Sharpe ratio. Then we have our constraints, our bounds, and our initial guess based on that. And we optimize our portfolio for our mean variance with risk aversion of 3. Then our target risk optimization, which is 12% volatility for our portfolio, which is basically what we're aiming for, and we rewrite the formula and calculate our weights based on that volatility and go back from there. There's our max return and our volatility target based on that, our max return based on the volatility. Gives us constraints, bounds, agains, and returns everything, and finish the portfolio optimizer. So then we have our Black Litterman implementation. Like I was saying, Black Litterman uses the market equilibrium because over time that changes in price just affect our overall return so much it doesn't give us an accurate representation of the market. So we want to use a smaller rolling average, usually 3 years. So it gives our equilibrium returns based on our market weights and our risk aversion 3. Our volatility and our covariance matrix, and then it calculates our strategic allocation as the market portfolio, calculates our equilibrium returns based on what was given in the market, and then if it sees that there's any changes needed, then we optimize those based on the market equilibrium with the Black Litterman, and return it in our data, which will give us our maximum Sharpe ratio with an accurate equilibrium. Then we have our Monte Carlo simulation. So that runs basically our return estimate thousands of times for each asset class to give us a couple estimations and a sample and a population metric to guess on certain different risk metrics and portfolio metrics. So here we have our portfolio parameters that it gives us, our weights, asset names, our returns, volatilities, and our statistics after running the simulation 2,000 times, as you can see here. And we have our storage, which is basically just keeping up with all our simulations. So we have our 2,000 different values, our final values, annual returns, and worst drawdowns, the maximum of that. It gives us our annual returns and the best portfolio pass and our final value and drawdown. Max draw, basically this calls back all these functions. Max drawdown right here, annualized simulation results for the 2,000. Gives us a lot of our basic stats, final values, we just talked about that, our real basic summary statistics, and then our actual implementation statistics and probabilities of what we actually want to do with this. So here we, chance that we preserve our capital, the chance that we beat inflation of 2.5%, chance we double our money, which you'll see over a 20-year time horizon, is actually possible in tripling, which is a lot less. And then our risk metrics of probability of loss each year, our average drawdown per year, and our worst case scenario, which is basically our value at risk of 95%. So we'll talk about that when we run the actual code. Then we have our validation, checks everything, gives us our sustainability and fiduciary checks, which we'll talk about right here in a second. A lot of checks us versus the benchmark, so it'll call that function. Client sustainability, so we want to make sure which one of these they are, conservative, moderate, or aggressive. Checks to make sure that they're within those bounds, so it's not let's say we had an aggressive investor, we might need to change this, and it'll let us know in the code. Checks our fiduciary requirements, checks that we have minimum diversification, cost efficiency, we're within the best client's interests. We just assume yes because we're talking to them, and we have documentation. We don't, but we assume so we just know that we need to put that in later. We check our diversification, make sure that it's not above 50%, as we said earlier in our limits. Our max weight is less than 50%, and then we check versus the benchmark to make sure that everything is up to date and our calculations are right, and then we'll give us an error if there are, and returns our validator. Then we have our rebalancing engine if we needed. We'll see in this example, everything is within our drift, so we don't really need to use that. I built another one that kind of rebalances from conservative to moderate and moderate to aggressive. So I mean that rebalances, but that's not really what we learned in the class. So I decided to focus on this to really showcase our concepts that I learned. What I learned better than the other one, which was just cooler and more convoluted and has more tools, but it didn't really explain what I was trying to learn. So our rebalancing engine makes sure our current asset was within the target weights and within our threshold, calculates our drift, which is how much of the weight has changed within this quarter based on like returns and whatnot. Rebalancing trades, basically if we're above the drift and we need to change anything, we'll be back within that allocation. Set that back. Then we go down to our rebalancing costs, like if we were to sell any stocks or buy any stocks, transaction costs, bid-ask spreads for selling any stocks, and our market impact, those all add up to about 20 BPS. So that'll depend on if we have any rebalancing and if there is anything we need to change. All right, part two, going right on after our costs, depending on if we have any trades, or recommended rebalancing approach, depending on our current weights, and if not, the reason because we're within our thresholds, which is usually what it'll say at the bottom. Given our example, our cost benefit analysis, basically, if the cost is more than what we've like our cost in trading, like selling our stocks, like say we're selling a tiny amount of stock just to rebalance, that wouldn't be worth the transaction cost. So maybe we don't want to make that trade and then let's let it ride. And our rebalancer just returns that. And then we move on to our visualization, gives us all our metrics, yada yada, runs through everything, gives us our code. I basically want to skip through all this. That's pretty much everything running through the code. Okay, I ran it. It takes a couple minutes to run this actual code, and my internet's bad, so I'm just going to leave it right here and show you what happened. Run through all 8 of our modules. We have our client portfolio over $1 million. Their risk tolerance is moderate. Their time horizon is 20 years. Basic metrics. Then we have our target allocations, our portfolio performances. So we had 8.9% return from that year. That all change. And then current allocation, it changed basically just a tiny bit of drift. So these two both bumped up. Bonds, I'm guessing, just stayed the same, but our overall percentage weight of the entire portfolio dropped based proportionally to these two. These two stocks increased 1.1% and 2.2% because they got a lot of return this year. Makes sense. They're the high return ones. And this probably either dropped, I'm guessing dropped, yeah, 10% to 9.9. Might have not done anything. Those are kind of stable too. Step 2, portfolio optimization, gives all our stats on those with the mean variance. So like, we want max Sharpe ratio of like US stocks 45%. That'll be outside of our drift, so we would need to rebalance and everything. Same with target risk. That just barely keeps it within our rebalance of 5%. That's the maximum we can do. It would be a lot more in these and a lot less in bonds. So target risk, 12% volatility, which is more than we have right now. Our Black Litterman basically shows us how much things changed based on their on the market equilibrium. So we can see here that like U.S. stocks changed 2%, 1%, 1.5, and 0.5. So they changed a little bit. The allocation would change definitely. U.S. stocks would drop, and international stocks and bonds would rise for sure. And our target volatility would be near that, so that's a good one. Validation, that's all good. Everything runs. Sorry, I got to speed through this. We only have 15 minutes. Monte Carlo runs through 2,000 simulations of each. Gives us our expected means over 20 years. So that's our big one, is final value, median value of 5th percentile, which is like 95th. And so that's the max we would earn, 95% chance that we would earn, and 5% chance that that's what we would lose. So 1.88 is what we'll say. So that's the value versus 95%. That's the value, the 95% chance that we will not lose $1.88 million after 20 years, which is a lot. That's more than our entire portfolio. So that's a big one. Our success probability, preserved capital is 99.8%, but that's great. Triple money, 93% over 20 years makes a little more sense, and 95% inflation. So the only one that's like, triple money, that's impressive, 73%, but that's kind of up in the air. Let's be real. Probability of loss is like 1 in 4, which is kind of big when I look at that. The probability of drawdown is 27%. And then this one is through the roof because it's 1.88 million, I'm pretty sure. So this is our target. Everything's nice and even. Currently post 1, everything has drifted a little bit. We've seen those drifts, just natural drifts and the weight changing. And then our recommended one, because it's not tactical, it's not outside of our boundaries, is the strategic. So that's just what we have. Gives us everything on a risk return graph, shows where everything is. So obviously, target risk, max risk means max return. Black Litterman's kind of just off. There's this frontier line, which we want. We can kind of see that curve. You want something on that, is what I'm guessing. Worst case 5%, yeah, 1.8 million, that's the worst case. Success probability is everything. Monte Carlo is not really that important. No rebalancing needed. Like I said, everything was in, so no tactical rebalancing needed. Everything just goes off for strategic analysis, projected outcomes, and then gives everything back. So 8.9% recommended allocation is just use our strategic one that we have already. Annual return 8%. That's solid. Sharpe ratio 5. That's decent. Huge like 20-year success. You'll make $8 million is our upper bound. So that's or sorry, $4.5 million. So that's pretty good. So we want to review and recommend this. Check for monitor every quarter.